Index funds versus individual stocks. One builds wealth, the other destroys it. Here's which one wins. Most people think picking individual stocks is how you get rich. But the data tells a different story. The majority of professional fund managers can't beat the market consistently, so why would you? Index funds give you instant diversification, low fees, and historically reliable returns without the stress of stock picking. Today I'm breaking down the pros and cons of each, showing you the math, and revealing which strategy actually builds more wealth over time. What are index funds? An index fund is a type of mutual fund, or ETF, that tracks a specific market index. The most popular is the S&P 500, which tracks the 500 largest publicly traded companies in the United States. When you buy an S&P 500 index fund, you own a tiny piece of Apple, Microsoft, Amazon, Google, Tesla, Johnson & Johnson, and 494 other companies, all in one purchase. Index funds are diversified. You own hundreds or thousands of companies, so one company's failure doesn't destroy your portfolio. Low cost. Expense ratios are typically 0.03% to 0.2% per year. You keep more of your returns. Passive. You're not trying to beat the market. You're capturing the market's long-term growth. Tax efficient. Low turnover means fewer taxable events. Index funds are boring. They're not exciting, but boring builds wealth. What are individual stocks? Individual stocks are shares of ownership in a single company. If you buy Apple stock, you own a piece of Apple. If Apple does well, you profit. If Apple crashes, you lose. Buying individual stocks is risky. Your success depends on the performance of individual companies. One bad earnings report can tank your portfolio. Time-consuming. You need to research companies, read earnings reports, follow market news, and constantly monitor performance. Expensive. Trading individual stocks can rack up fees, especially if you're buying and selling frequently. Emotionally taxing. Watching your stocks swing up and down creates stress and often leads to bad decisions. Selling low, buying high. Some people get rich picking stocks. Most people lose money trying. The data. Index funds win. Here's the uncomfortable truth for stock pickers. Over the long term, index funds outperform the vast majority of actively managed portfolios. According to the S&P Dow Jones Indices SPIVA report, over a 15-year period, more than 90% of actively managed funds fail to beat the S&P 500. These are professional fund managers with teams of analysts, advanced algorithms, and insider access, and they still can't beat a simple index fund. If professionals can't do it, why do everyday investors think they can? Warren Buffett, one of the greatest investors of all time, recommends index funds for most people. He's famously said that when he dies, his advice to his wife is to put 90% of the money in a low-cost S&P 500 index fund. If Warren Buffett recommends index funds, that should tell you something. Why index funds build more wealth? Reason 1. Diversification protects you. When you own an index fund, you're not betting on one company. You're betting on the entire market. If one company fails, the other 499 keep your portfolio growing. Individual stock investors put too many eggs in one basket. They fall in love with a company, overinvest, and when that company crashes, they lose everything. Reason 2. Lower fees mean more money stays invested. Index funds have expense ratios as low as 0.03%. That means for every $10,000 invested, you pay $3 per year in fees. Actively managed funds charge 0.5% to 2% or more. That's $50 to $200 per year on $10,000. Over 30 years, those fees compound into tens of thousands of dollars lost. Lower fees equals more wealth. Reason 3. You avoid emotional decisions. Individual stock investors panic. They see their stock drop 20% and sell at a loss. They see a stock rally and buy at the peak. They trade too often, chase trends, and destroy their returns with bad timing. Index fund investors set it and forget it. The market goes up, they win. The market goes down, they buy more at a discount and wait for the recovery. No emotion, no panic, just discipline. Reason 4. Time in the market beats timing the market. The S&P 500 has averaged about 10% annual returns over the last century. Some years it's up 25%. Some years it's down 15%. But over time, it trends upward. Index fund investors capture that average return. Stock pickers try to time entries and exits, and they almost always underperform because they miss the best days in the market. Missing just the 10 best days in the market over a 20-year period cuts your returns in half. You can't time it, so stop trying. For a deep dive into long-term, value-driven investing strategies that work, check out The Intelligent Investor by Benjamin Graham. It's the book Warren Buffett credits with shaping his investment philosophy. Links in the description. When individual stocks make sense, I'm not saying individual stocks are always bad. There are scenarios where they make sense. Scenario 1. You have expertise in a specific industry. If you work in tech and deeply understand the competitive landscape, you might have an edge picking tech stocks. But even then, most people overestimate their edge. Scenario 2. You're investing money you can afford to lose. If you've maxed out retirement accounts, built wealth in index funds, and you want to take 5 or 10% of your portfolio and pick stocks for fun, go ahead. Just know it's speculative, not wealth building. Scenario 3. You're willing to put in the time. If you're committed to reading earnings reports, studying financial statements, and monitoring your holdings daily, you might beat the market. But most people aren't willing to do that work. For the other 99% of people, index funds are the smarter choice. The wealth building strategy. Index funds first. Here's the strategy that works. Step 1. Max out tax-advantaged accounts with index funds. Your 401k and Roth IRA should be filled with low-cost index funds. An S&P 500 fund or a total market index fund is all you need. Set it, forget it, and let it compound for decades. Step 2. Build a taxable brokerage account with index funds. Once you're maxing out retirement accounts, open a taxable brokerage account. Invest in the same index funds. This account grows without contribution limits and gives you flexibility. Step 3. If you want to pick stocks, allocate 5 to 10%. After your wealth-building foundation is solid, take a small portion of your portfolio and experiment with individual stocks. Think of it as your play money. If you lose it, it doesn't matter. If you win, great. The key is this: index funds are the foundation. Individual stocks are optional and speculative. For a comprehensive guide to building wealth through disciplined investing, grab Money, Master the Game by Tony Robbins. It breaks down strategies used by billionaires that everyday people can replicate. Links in the description. The math. Index funds versus stock picking. Let's compare two investors over 30 years. Investor A. Index fund investor invests $500 per month in an S&P 500 index fund. Averages 10% annual returns, pays 0.03% in fees after 30 years. $1,130,000. Investor B. Stock picker invests $500 per month in individual stocks, averages 7% annual returns. Underperforms due to poor timing and stock selection. Pays 1% in fees and trading. Costs after 30 years. $520,000. Investor A ends up with more than double the wealth of Investor B. Same contributions, same time period. The difference, Strategy and fees. Stock picking is expensive and usually underperforms. Index investing is cheap and consistently outperforms. The psychological trap of stock picking. Here's why people keep picking stocks even though the data says they shouldn't. It's exciting. Buying an index fund feels boring. There's no thrill, no big win. Just slow, steady growth. Picking stocks feels like gambling. You get the rush of a win when your stock jumps 20%. You tell yourself you're smarter than the market. You chase that high. But over time, the losses add up. The missed opportunities compound, and you end up with less wealth than if you just bought an index fund and walked away. Wealth building isn't about excitement. It's about discipline, consistency, and letting time do the work. Your next move, if you're not investing yet, open a retirement account this week. Vanguard, Fidelity, or Charles Schwab, any of them work. Choose an S&P 500 index fund or a target date fund. Set up automatic contributions and let it run. If you're already investing in individual stocks, take an honest look at your returns over the last 5 years. Compare them to the S&P 500. If you're underperforming, shift your strategy. Move the majority of your portfolio into index funds and stop trying to beat the market. You don't need to be a stock-picking genius to build wealth. You just need to invest consistently in low-cost index funds and let compound interest do the rest. That's wealth mode. If this video was helpful, please click the subscribe button and then like and share with your family and friends.